Well, the stepped up base is what has allowed us to achieve what I think has been the dream of every family that's come into existence. And that is every parent wants their children to be better off than they are. That's the motivation that drives us. That's what makes us work harder, is to make life better for our children. Congress is looking at 1031 saying, ooh, it's these evil rich people getting away with capital gains tax. We've got to take it from them so we can give it to others. The unintended consequence of that is so massive.
And I couldn't agree with you more, Dave. And in fact, I feel like it's the big domino, right? The big unintended domino. Sometimes it feels like it's intended because honestly, I just don't understand what's the next thing to go, an IRA or a 401k? Hello, everybody, and welcome to the Build It to Billions podcast, where we believe a lot of entrepreneurs, millionaires who are increasing their capital through scaling their businesses to billionaires are looking for ways to dive even deeper into strategies to help their clients and their investors every single day by finding ways to model and to impact others that have done it in a big way. And we're here in the studio to learn every single day from guests who are experts in their field, in their craft. And today's guest is no exception. He is an expert and a master when it comes to all things 1031 exchanges. He's actually a previous guest on the Capital Gains Tax Solutions podcast, and now he's a new guest here on the Build It to Billions podcast. He is out of the great state of Florida. Please welcome to the show with me, Dave Foster. Dave, how are we doing?
Hey, it's awesome to be here with you today. And it's awesome to be in the great state of Florida.
Absolutely. In fact, this is today's topic at hand. We're talking about all things 1031 exchanges. We're going to be diving in a little bit into the deferred sales trust as well, but mainly these big proposals that are on the table with, really game-changing, maybe fabric of America changing things, such as the elimination of the stepped-up basis, the 1031 exchange being capped at about $500,000. And the increase of capital gains tax to over 44% federal. So, Dave, before we dive into all of those things, give our listeners just a little bit more about your background and your focus and your specialty over all these years.
Yeah, well, it's kind of amazing that life happens in an instant, doesn't it? 30 years ago, I was looking to get off the corporate train and do something different, like really different, like raise my family on a sailboat. And that's when I discovered the 1031 exchange. And here we are 30 years later. We managed to get 10 years on the sailboat using the 1031 exchange without paying a penny in capital gains tax. And now we've been doing that for over 25 years for others as well. So it was a tactic that I fell in love with. And then I went, as my grandpappy used to say, 2 miles deep in a 2-foot wide creek and tried to discover every way possibly that we could use which is what I think is the second greatest tool given to us in the real estate code to add wealth to ourselves. The first one being the primary residence exception. The fact that anybody in America can buy a house, move into it, live in it for 2 years, and sell that, and then take the first $250,000 or $500 if you're married. $500,000 of profit, tax-free. I mean, come on, that's a job by itself, a tax-free job. And when they changed the law that's been almost 20 or 30 years ago, where you can now do this once every 2 years, I don't know why everybody's not doing it. I mean, I guess you get stuck in a place, I know, and the spouse has to be willing to move. But as long as you've got that, you've got a whole world of tax-free money available to you.
And it's true. And then isn't that kind of the American dream, right? To be able to pursuit of happiness and hopefully the pursuit of some margin in your life and ways that you can build wealth, especially with ownership and real estate and to bring value and hopefully find value and invest into value, take some risk along the way, which leads into, I think, the big topic right now, which is this 1031 exchange, Dave, right? And potentially the capping of this, the stepped up basis elimination, and the proposal of Biden's tax plan of increasing capital gains tax to 44%. So which one do you like to start with? And let's just dive right into what's at stake here for.
I get chills from all of them. Yeah, Congress seems to have never met a tax they don't like. But along with everything that the government does, everything that we do, there's always those unintended consequences, aren't there? And if you go back to the very beginning, Brett, in 1920, when 1031s were memorialized into law, the reason was very specific. It was because our nation was transitioning from small agricultural endeavors, and our country was hungry. It had just left World War One and was growing like crazy. We needed big agribusiness. We needed also a transition to industrialized business. And the problem was that we still had a whole nation of farmers that were living and raising, working on 160 acres. Does that number ring a bell to you?
160 acres?
160 acres.
No.
The Homestead Law of 1860 allowed anybody in America in a whole lot of national lands to be able to claim for free 160 acres and build what is called their homestead. So we had all kinds of farms, but how can you scale on 160 acres? Enough to feed a hungry country. So what happened was Congress put 1031 into place so that now these farmers who couldn't sell and buy their next farm because they couldn't afford it after they paid the tax could now defer the tax and go buy a bigger farm. And you know what else that allowed? All of these young farmers, young kids that wanted to become farmers, to be able to buy a small farm. And that just added, it was like adding gasoline to a fire on our nation's agribusiness. Now, fast forward 104 years, and Congress is looking at 1031 saying, ooh, it's these evil rich people getting away with capital gains tax. We've got to take it from them so we can give it to others. The unintended consequence of that is so massive because if you tell a big investor that they're not going to be able to defer tax on a huge sale, are they going to sell? Not nearly as likely. And if they don't sell, what's going to happen to the smaller investor that's wanting to buy up? What's going to happen to the entry level investor? You're basically going to stall out a great deal of the real estate economy. And the problem is, let's go even further. When you do that, because the proposal is to increase the capital gains, right? Well, okay, 1031 is the mitigator of that. But if you raise capital gains and take away the incentive to sell property, now you had a bad double whammy. And I know they're just talking about limiting capital gains to 500,000. And there's a couple things we can talk about along that, but still, it's going to really shrink the available pool of growth. And when you do that, guess who else is not going to make money? If you've got fewer real estate transactions, then you have two fewer realtors, two fewer title companies, two painters, two appraisers, two inspectors, and all of a sudden they're all losing business. When they lose business, they're not paying tax. And they're paying tax at the higher ordinary income rate. And just like you and I both know, if we're not making money, I don't go to the store and buy a new car. And if I don't buy a new car, the car salesman doesn't buy new groceries. And that's how that ripple effect, which Ernst and Young and several other very respected institutions have done studies that show the billions of dollars that's going to be lost if we endure the unintended consequences of getting away or sharply curtailing the 1031 exchange.
I couldn't agree with you more. By the way, Dave Foster can be found at 1031.com, 1031. Is it the1031.com or is it
The
1031?
1031
I'm sorry,
investor.
at the1031investor.com. I'm sorry,
Yeah.
the1031investor.com. And I couldn't agree with you more, Dave. And in fact, I feel like it's the big domino, right? The big unintended domino. And or maybe it's just, whether sometimes it feels like it's intended because honestly, I just don't understand, like what's the next thing to go, an IRA or a 401k, right? I mean, and then we're talking about the stepped up basis. That's the proposal, but we're never going to tax our way out of this. I mean, $35 trillion in counting in debt, right? On and seeing a lot of inflation the last year and a half, interest rates doubling, and to then double down on other strategies that are actually going to pull us out of this, right? That it was a part of the big boom, like you talked about, over all of the years. In fact, I call it the reverse Tea Party, Dave. This is my thought, right? 240 plus years ago in America, we fought for what? Representation for the tax that we were paying, right? We didn't feel like we were getting the proper rights and freedoms
Yeah.
that we were earning. And now the biggest wealth transfer or the biggest wealth accumulation has happened over those 240 years, arguably in the more than the history of the planet that we know of, and most of it being with Americans, a lot of them which are baby boomers who have built their wealth with the 1031 exchange, and now they're and the 121 exclusion that you mentioned, and now they're facing, what? Don't sell. And by the way, if you don't sell, then you thought you could get the stepped up basis, the 1031 exchange, but if it's capped at $500,000 of gain, then that kind of negates a lot of the 1031 exchanges. But let's talk about this. Let's talk about this stepped up basis issue, right? Because now, I mean, now you're stuck between a rock and a hard place, because if you go for the 1031 and it's capped at 500, well, that doesn't solve it, right? Especially if you're greater than that. And then number two, if you actually just sell and pay the tax, it's at 44% federal. That's just federal. State of California is on a 13.3. Some of these other states are, 5, 7, 10, right? But if you don't have this stepped up basis, talk about, I mean, changing the entire fabric of America. I mean, walk us through, Dave, what your thoughts are on that.
Yeah. Well, the stepped up basis is what has allowed us to achieve what I think has been the dream of every family that's come into existence. And that is every parent wants their children to be better off than they are. That's the motivation that drives us. That's what makes us work harder, is to make life better for our children. If in one fell, the step up basis allows you to transfer assets to your heirs without them having to pay tax on it and without you having to pay tax on it. In other words, what you earned over time gets to go to your children so they can have that better life. And that's pretty awesome. If you, though, take that away, here's what I think is going to be an unintended consequence on that, Brett. If you take away that motivation, and I'm sitting here as, a guy that's closer to death than not, and I've got all these assets and I can't give them to my children, what am I to do? I'm going to spend. And what is the kiss of death? Or what causes inflation? Too much money, excess spending. So all of these people starting to spend money, it will actually end up exacerbating the inflationary forces that are in our country right now. And as soon as you do that, then you've got the ripple effect. It starts to cycle. So yeah, I think there can be reasonable things, but doesn't it kind of seem like all roads here lead to the great wealth transfer being not from us to our kids, but from everybody to the government?
Exactly right. That's the reverse Tea Party, right? So we fought for the freedoms to build the massive amount of wealth, right? With many blessings from God and many hardworking entrepreneurs and who fought in wars, who fought, to build their businesses, own real estate, invest, work hard, just for it to be transferred to no matter what side you vote for, Dave.
Yeah,
They tend to waste it away, don't spend it very efficiently, have not enough transparency or accountability. And that is the political climate we find ourselves in, because there's $35 trillion. Now, if we were 35 trillion in the surplus, right, perhaps they can make an argument for why they need to do these things. But the problem is these solutions don't solve it by increasing tax, by de-incentivizing the American people. And this is part of the big domino. So let's talk about some, let's also touch on the capital gains tax rate. So 44% would be the federal, right, moving from about 20%. When you're selling basically a deal worth $1 million or greater, depending on your income, different things, but it's, the brackets, but we're talking about larger exits. But basically when you're over $1 million of selling something, it's going to be 20% or upwards of 44%, which leads into a little bit about what we touched upon before the show, which was what are some possible solutions for this, right? So here's my thought, and I'm going to throw it out to you, Dave, right? So right now they're attacking owners, equity owners, right? Those who own the real estate. The stepped-up basis is attack on ownership. Taking away the 1031 exchange is attack on ownership, because the 1031 exchange is the continuity of ownership. It's full control. It's moving your ownership for more ownership and trading up until you get the stepped-up basis, which then the capital gains tax rate steps up, and your children can take that ownership at capital gains tax free. Here are the two things where I think things are moving to. Number one, estate tax, right? So estate tax has nothing to do with the stepped up basis, and the 1031 never solved for that. And that was one of the downsides for the 1031. And that the exemptions are set to be about 12 to 14 million married for a married couple as of 2026, maybe about 6 to 7 for a single individual. And so the government's biggest mousetrap is this 40% death tax, which could cause someone to do one of two things: either have to sell before they die, which gets rid of the kind of negates the stepped up basis premise, right? But can get it outside of the taxable estate, and or try to do some gifting or buy expensive life insurance. Now we have a solution called the Deferred Sales Trust Plus, and here's why it's different. It's not ownership directly, it's indirect through it's actually lending to an entity of which owes you the money, right? And so it's using installment sale, 453 installment sale, to move the ownership hat to a lender. And then we have a different one that's outside of 453 that moves it outside the taxable estate. And so it seems like certain laws at different periods of time are more favorable, or another way to put it, those who have the experts and those who have the attorneys to draft their estates and work the tax laws in a way benefit; those who don't miss out. So what are your initial thoughts on just the estate tax challenge as well, and just looking at different strategies because things might change?
Yeah, I think the estate tax is a bit of a joker because it does fluctuate greatly over time. And then it has its sunsets and it comes back. So that's kind of a little tougher animal to pin down. And, quite honestly, although it tears my heart to say this, I'm not totally opposed to some. And when you talk to people like Warren Buffett, they would say the exact same thing, that, okay, we've lived here, we've enjoyed it, but let's make it reasonable. Let's not take it all away. Because again, when you take money out of the hands of individuals and put it in the hands of the government, sorry to say, but it will never be spent as effectively. And that's free market Dave talking, but I realize, but I got a sense that I'm talking to a kindred spirit here as well.
You are.
Um, so the estate tax is what it is, and the idea is going to be that you want to try to keep it under the maximum as much as you can, and that's where a lot of these types of strategies, like what you're talking about with the deferred sales trust, where you live, or where I'm at with the 1031 exchange, because the key to mitigating, not eliminating, but mitigating some of this with the 1031 is that you create different entity structures that are going to survive me. So I might create trusts or different corporations, LLCs, partnerships with my heirs so that it can grow and then continue beyond me. And yeah, my stuff is going to get taxed, but there's also going to be the opportunity to still pass along a lot of that. And the reason we can do that is because any tax-paying entity can do a 1031 exchange. It's just going to be in how they do it and then who's going to be the benefactors of it.
We're talking with Dave Foster, the1031investor.com. The1031investor.com is also an amazing contributor on Bigger Pockets as well. So if you check out Bigger Pockets and the blogs, Dave does an amazing job of educating and equipping and empowering people with the 1031 exchange. Yeah, so two quick things on the deferred sales trust. One, we can eliminate the estate tax. We can defer the capital gains tax. One of the downsides with the deferred sales trust is you don't get the stepped up basis, right? By the way, you can either have a stepped up basis or it can be outside your taxable estate,
Right.
but you can't have both. So just a general rule of thumb, find out what you're solving for. And so one of our rule of thumbs is for the first, again, 6 to 7 million per individual. You can keep using the 1031, keep using the stepped up basis if it's still around, right? And you're golden, right? You don't need any estate tax planning. But for amounts that are over and above that, you can sell while you're still alive, move it into what's called the DST plus. Not to be confused with the Delaware Statutory Trust. This is a Deferred Sales Trust Plus, or the Deferred Sales Trust 2.0, and we can eliminate the estate tax. There's no gifting required. There's no other new corporations required. There's a new trust that you're gonna sell to and this trust is going to sell to the ultimate buyer. So it's not a transferring of the asset into a new entity. It's actually selling it to this new entity in exchange for a promissory note, more known like a private annuity type of a structure. And then your children can be the beneficiaries. And here's the cool thing, Dave, they can inherit it estate tax free and capital gains tax free. However, the payment to the individuals over their lifetime, they're paying part capital gains tax and part interest, ordinary income. So it's not as favorable during their lifetime. If people want to learn more about that, you can go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com. But Dave, I know a lot of people, they look at the Delaware statutory trust, they get confused and they think about the deferred sales trust. What are your general thoughts, right? Because I know I came from an industry of 1031 exchanges, and I was beating the drum, and I still beat the drum too, to an extent, at Marcus and Millichap, helping people. But the 2006 was when everything was pretty hot, and then 07, 08, things really changed, and I saw friends, family, and clients have too much debt, not enough liquidity, and had overpaid, and they felt like the tax tail was wagging the investment dog, and they went on to lose half or all of their wealth over a couple year period of time. And we identified as a 1030 at that point is not their friend, right? And so I was in Taxifornia. If you imagine, it was Sacramento, Roseville area, and I'm seeing this kind of this aftermath of all of it. This is actually the origin story of when I learned about the deferred sales trust, and I started to say, well, if this is true, and if we can solve the problem with timing and combining what's called tax flow, I call it cash flow, and the last one is debt flow. If we can combine these three concepts within a strategy that gives time back to the investor, gives leverage back to the investor, and not have to do the 1031 exchange, that can change everything for the investor, right? And we've gone on to do that. In fact, we were talking about a $13 million deal we did in San Diego just about 2 years ago, before the market and the interest rates about doubled, and they got out of debt, they got diversified, they got liquid. The funds have been invested mostly in money market and lending funds, all tax deferred. And now we're buying back into these syndications that have dropped in value. We bought into Bitcoin that was very low at 40,000 a coin and has skyrocketed. And they're also looking for land to purchase to build more car washes. So what are your overall thoughts on the deferred sales trust and some of those concepts with debt flow, tax flow, and cash flow combining with the deferred sales trust?
I like how you break it down into those three different aspects because that follows through no matter what we're doing, investing wise, fixed asset, real estate, equities, DSTs, 1031s, whatever. You've always got to manage that debt, tax, and cash as you're going. Now, honestly, and you and I have had a bunch of discussions on this. I have never been partial personally to the deferred sales trust simply because Dave has this pathologic fear of losing control. That's just me. But as we move towards an environment where, in order to shelter the tax for our heirs, we find ourselves needing to give up control at some time, they do start to become more attractive. And that's what you were just talking about. So that at some time, if I'm bumping the estate limits and I still want to give to my heirs, a deferred sales trust, as you're talking about, where my heirs get to inherit, well, I've given them all I can. If it's up to them after that, and I don't care, right? So I love that as a new solution for late in life. For mid career, I'm still liking what we're seeing and what we're able to do with the 1031 because we can start to recession proof. I went through '08 too, my friend, and trust me, it was not pretty. I can't tell you how many times you've done this too before, Brett, where we had to do a 1031 exchange where they had to bring a lot of money to the table. They were selling so far underwater, and yet because of their debt and because of the deferred gain, they still had to do the 1031, but they had no money to sell the property. I mean, those were very sad days. What we've started to see with and encourage with our investors is to do an idea very similar to rat holing if you're playing poker. You take your money off the table as quickly as you can. And you do that in this way specifically with the 1031 exchange. It's what's called a diversification exchange, where you sell a larger asset. And let's say you're selling a $500,000 asset that's got 250, $200,000 in gain. So you've got $300,000 in cash. Now, we all know what it's like to borrow money in this day. But what if you took 250,000 and bought an asset for cash? So you buy a piece of real estate for cash. Right there, you just started to shelter your wealth. All you got to do is keep the lights on. And you take the other $50,000 and you use that as a down payment at an obscene interest rate. Now, I get it. But to buy a $250,000 property. Now, that's going to satisfy the 1031 because you purchased at least as much as you sold. You used all your proceeds to do it. But look at what you did. You've got a free and clear asset that's generating income and it's safe. If everything went to heck in a handbasket, you've still got that property and they can't take it from you. Meanwhile, you're still getting the arbitrage from also a property that's got debt. And of course, the tenant is hopefully paying that mortgage. So you're getting the other components of the internal rate of return. That's really boosting your return up. And if an '08 happens and the bank gets that property, so be it. But you've still got the free and clear one. And we're starting to see people peel those away time after time, where they're aiming towards a debt-free portfolio. And then what they will do, because they're not going to care so much about the tax, is they're going to start selling their properties one at a time. Or this, I think, is where the Delaware Statutory Trust really comes into its own. Because the Delaware Statutory Trust turns your gain, turns your debt from recourse debt where you owe the money to non-recourse debt where you're not personally responsible. So you're able to eliminate personal responsibility for the debt. But because the DSTs, Delaware Statutory Trusts, are compatible as real estate, you still get the benefit of the amortization of the loan and the depreciation benefits. That's huge when it comes to offsetting income, as well as the appreciation that's on them. So, can Delaware Statutory Trust go south? Absolutely. Everything can. Everything has. Dare we say everything will? Just hopefully not tomorrow. But there's ways to mitigate it. And I really like the flow for me of going through the 1031 exchange, recession proofing, moving into passive, and then I'm actually starting to become more of a fan of the idea as capital, as the step up in basis is taken away, to then moving that into a vehicle like a deferred sales trust, so that at the end it gets to my heirs and they can worry about what happens after that.
Well, I thank you for that. By the way, Dave, I want to touch on choose your control, right? Because this is number one reason. And by the way, hi, my name is Brett Swartz, and I'm a control junkie like Dave Foster is, right? When it comes to owning, managing, building wealth. In fact, I grew up in the Bay Area buying and building houses with my parents, right? Literally from the ground up. And talk about construction and owning and rentals, right? So it's in the blood. I totally get it. But here's the thing, I say choose your control, right? Because you're right. If the government takes away the stepped up basis, guess what? You just chose for the government to take control, right? If you're above those estate tax exemption amounts, guess what? You are choosing the government to take control. And so you can choose to work with a third party unrelated trustee. By the way, that's what we do here at Capital Gains Tax Solutions. I'm also founder of that company. This is, if you're wondering on this podcast listening for the first time. And in a sense, it kind of formed like a mini IRA, a mini 401k, a mini 1031, where the funds are owed you the money. Now, a lot of people, I think they confuse or they're not comfortable as much because they've never done it before. Like, in other words, an installment sale, you are the lender. You have all the rights and protections of a bank. Same thing with the trust, the deferred sales trust. You lend the money to the trust and you actually have all the rights and protections, but you also have the controls to do kind of like a self-directed IRA. If you've ever done that before, Dave, or familiar with that, where you can partner with
Yeah.
the trust within a week, setting up a new LLC And guess what? You can manage and build and buy real estate and run your deals again as the trust as the joint venture partner. Now, here's the reality. In the trust, there's probably an extra 25 to 50% more proceeds because you didn't pay that in tax that you can then partner with to go buy more real estate assets and you can run again. And so I actually think it's a myth that you're giving up too much control with the deferred sales trust. Are you giving up some controls? Yes. You got to work with the third party trustee. But by the way, if I'm doing a 1031 exchange, guess what I'm doing? I'm giving up some control for a period of time. 45 days, 180 until I satisfy the exchange requirements that the accommodator will put the money back into the next deal. So that what I would say on that. The other thing I think is I love what you said about the Delaware Statutory Trust. And by the way, sometimes it's one or the other. Sometimes it's all three. Sometimes it's a 1031 exchange, a Delaware Statutory Trust, and a deferred sales trust. In fact, what you were talking about before had to do with what's called debt over basis. And for those that are wondering, the challenge becomes, well, when would you need to bring money to something? Well, you've depreciated the assets so much that you've refinanced it over the time, and you have a debt over basis challenge. In fact, we're working on a $14 million deal in Sacramento today. They have a $7 million debt. They have zero basis, and they're looking at this exact deferred sales trust plan. And the challenge is if they did a 1031 exchange, interest rates, they're going from 3% to perhaps 6.5%. Okay. And their equity is only about 7 million. And if they did that exchange and they have to replace the equal or greater value or equal or greater debt, they're going to put themselves in a very low cash flow position. And so here's how we're going to solve it, Dave. You ready? We're going to first send it to a 1031 exchange accommodator. Number two, we're going to do a partial Delaware statutory trust. We're going to put it into what's called an Amazon zero coupon deal, which has about typically around 80% LTV. They're going to put about 20% down on that $7 million debt over basis challenge, Dave. And that's going to get that debt out of their name, non-recourse, replace the debt. The debt is gone forever, okay? Or at least it's on the Amazon deal and Amazon's going to be paying down their debt. Now the remaining in this scenario, let's call it about six. I think it's going to be about 6 million, maybe 5.8. With the debt over basis. That remainder is going to go into the deferred sales trust. Okay, so now they're debt free, they're tax deferred, and the money is sitting there. And guess what? That apartment complex that may take a little bit of time to decrease in value, when they go to buy it, Dave, they're still going to buy the same deal that they would have bought with the 1031 if they were to do it, but hopefully they negotiate a lower price. But they're going to form a new LLC, Dave, and this new LLC is going to give them what? A brand new depreciation schedule. Okay, so it's a fresh depreciation schedule now, which they get about 80% of it the way we structure it to keep it commercially reasonable. But they're going to use what they would have paid in tax deferred. They're going to be out of debt, and they're going to have optimal timing with the fresh depreciation schedule. So essentially, we're flipping on its head what the 1031 does not offer, which is a new depreciation schedule, which is timing, right? And is the ability to get out of that debt with the Delaware and still have the liquidity to do what you want to do. And in fact, here's what I'm finding, Dave. A lot of these baby boomers, they're tired of not only the toilets, trash, and the termites, they're also tired of the rent control, the government regulation, the ongoing, even these Walgreens or these CVSs that are, just going dark, right? They're closing up shop. They want to be able to diversify in a way that gives them the ability to dollar cost average, right? In fact, you can go into the stock market. I'm not a big stock market guy, but you can go into the stock market. You can put it into T-bills. You can go into hard money lending. You can go into syndications with this. And I think you can truly diversify with the deferred sales trust versus just a hard asset that's illiquid or requires you to go into debt. So I will pass it back to you. By the way, capitalgainstaxsolutions.com if you want to learn more about that. But Dave, what's your rebuttal to that, or what did I miss?
Yeah. Well, I don't know if there's a rebuttal, but you warmed my heart with your talk about the compounding effect, because that's really what this is all about. No matter how you do it, if you pay tax to the government, you're going to get benefit of some sort. You get hospitals, roads, and everything. If you get to keep the tax and use it for yourself, you get the benefit for yourself. And I honestly think that people are better judges of spending their own money than they are letting the government spend their money.
Fair enough. Fair enough. By the way, you can learn more about Dave by going to the1031investor.com, the1031investor.com. We're running out of time, Dave. Are you ready for the lightning round?
Oh, let's go for it.
All right. Knowing what you know now, if you could go back to your 20 to 25-year-old self and you're sitting down with the person you most admire or respect it, what's the one golden nugget they would tell you that would make the biggest difference for your future?
Oh, that they would tell me, oh, there's a twist. Uh, patience, patience. The cycle will go, the cycle will come. Wait till it comes.
Perfect. Question number 2. What's the number one book you've recommended or gifted the most in the past year?
The number one in the past this year. I'm loving just one particular book in the Bible, Proverbs. I think there's everything you need to know about running business and life found in the book of Proverbs.
Fantastic. Question number 3. What are you most curious about right now? And you feel free to say the deferred sales trust now that we've talked.
Okay, the deferred sales trust, of course, followed very closely by I have a son who just moved to Nome, Alaska. And so now I'm learning vicariously about the Great White North, which is a little bit different from the Great White South here, where the white is beaches.
Awesome. Question number, I guess 5, I think at this point. Number one leadership quote or theme that you strive to live by.
It's amazing what people can accomplish when nobody cares who gets the credit.
Fantastic. And last question on the Build to Billions podcast, we're really focused on changing our mindset from ownership to stewardship. We believe we've been given certain gifts, and these gifts being a blessing to be a blessing and help to others. Even the equity and the wealth that we've built has really been an opportunity from a gift. So how do we best be stewards versus owners? And so what is your way, Dave, that you feel you give back something you're passionate about, and a way that you've been able to steward your wealth and to give and be able to bless others that are perhaps the most vulnerable in this world?
Yeah, we mentor young men just coming out of high school because I think that our high school system has been woefully inadequate at preparing our children for life skills. I used to say writing checks, but nobody does that anymore. But financial acumen, learning how to shop, for heaven's sake, how to find deals, how to calculate interest rates, those kinds of things. So we've set off on a course of mentoring young men and bringing them into our house to live with us. And that's, yeah, what a blessing. I think though, Brett, if I could take 15 more seconds, the first key is to make sure you love yourself. Because if you love yourself, you want to do right by yourself. And that will let you fulfill the second greatest commandment of God, which is to love others as yourself. And that's what we're striving to do. Live a great life, but then live a great life and help others live the same kind of great life.
Dave Foster, everybody. Dave, I want to thank you for being on the show. I want to thank you for being a guest here, sharing so much wisdom, going back and forth with me on the 1031 exchange versus the deferred sales trust, diving into the Delaware statutory trust, and essentially being on the front lines of helping people create and preserve more wealth. But more than that, unlock capital gains to multiply freedom and impact. And in fact, that's our mission at Capital Gains Tax Solutions, is to do just that. And you are a part of that with the 1031 exchanges, and it warms my heart to have you on the show. Thank you so much. And for our listeners who want to get in touch with you, we remind them one last time, what's the best place for them to find you?
Find us at the1031investor.com.
Fantastic. And I want to thank all of our listeners for listening to the Build to Billions podcast. Again, we believe a lot of entrepreneurs who are scaling from 1 million to a billion, sometimes they struggle with clarifying, different strategies and or taking a mindset of ownership versus stewardship. We encourage you to make an impact and to be thinking about that today, and to take these strategies today to increase your tax flow, debt flow, and cash flow game. And hopefully it equips you today to do just that. Please share, review, rate, subscribe, all of the above, YouTube and all the podcast channels. And we'll talk to you again real soon. Bye, everybody.